Hello and welcome again to Money Talks, and I'm delighted once again to welcome Edmund Shing, whose book The Idle Investor is out shortly, and Edmund is an asset manager with BCS Asset Management. Edmund, welcome again.
Thank you.
Now, you're writing a column this week for IBTimes UK about cash investments. Now, I'm old enough to remember when cash was king in the 1990s. Cash is king, George, they used to say. Can't go wrong in cash. How's it changed?
Pretty dramatically, George, because back in the early 1990s, interest rates were at double digits, 10, 11, 13%. Today, in contrast, with these ultra low interest rates, a bank deposit account will yield you probably at best 1.25%. Now, for an average retail investor putting their money into the bank, taking account of interest and tax, that's losing you money in real terms. So the value of your deposit is going down year by year by year at the moment.
I see, but people don't seem to be getting that message that cash really isn't earning them any money, and inflation's higher than you'll be getting off your deposit rates at the bank, because don't people have a lot of money in cash at the moment?
Yes, bizarrely enough, despite the current state of affairs and the very low interest rates, they still do. In the UK, nearly 30% of all financial assets held by households are in cash still.
And is the rest of their money in shares?
No, not at all. Only 10% of their money is in shares. Actually, nearly 50% are in pension funds and life insurance funds.
And how much is this to do with punters, investors feeling that their fingers are likely to be burnt in the stock markets? Memories of 2008 and the huge world meltdown in share prices must still be very close to investors' hearts.
In fact, if we look over the last 14 years, there have been two occasions where investors have lost nearly 50% of their money in stocks. So clearly they're rather chastened by the experience and loath to go back for a third time.
So are you saying don't have so much money in cash, and are you saying you should be more invested in equities?
I'm saying two things, George. I'm saying if you want to keep some money in cash, which I think actually is still quite sensible, not as much as 30% of your assets, but a bit,
yes,
then go for high-yielding regular savings accounts, which yield 5 to 6% at banks such as HSBC, First Direct, Nationwide. There are 3 or 4 that offer you those types of interest rates on a limited amount of money.
And of course, if you need an income, if you need access to cash, presumably there are income shares that you can invest in.
And that's the other place I would go. Exactly, George. If you look at the UK stock market today, you can find lots of good income shares. And in fact, in the article, I used what we call a screening process. This is actually a company called Stockopedia that allow you to rank companies by different characteristics. In this case, I took companies which give a high dividend yield, so a high interest rate, but also have a high quality and value ranking. So i.e. companies that are high quality and also which are cheap.
And can I buy into a fund if I want to spread my risk?
Absolutely, you can. So you have the choice. You can buy the individual shares like Berkeley Group, the house builder, for instance, or Friends Life, the insurer, or
specifically for an income.
Specifically for income, because not only do they pay a good dividend today, but typically with shares like Berkeley Group, they grow their dividends rather consistently over time. And that's very important. It's not what you get in the bank. You don't get your interest rate going up year by year. With these stocks, if you hold onto them, you probably will.
Well, there you have it. Thank you very much, Edmund. It seems that we have too much money in cash. Don't please stuff it under the mattress. Make it work for you. And you can find instruments by reading Edmund Shing's column in IBTimes UK. Please join us again. Thank you, Edmund.
Thank you.